For most retail day traders, the daily routine is a high-stress scramble to chase extreme price swings and predict unpredictable breakouts. That standard playbook carries hidden costs, a dangerous reliance on leverage to force profits, exposure to offshore broker insolvency, and heavy tax penalties that eat into your successful trades. Now, imagine a counterintuitive alternative, a market engineered specifically for stability and capital preservation rather than chaos. This is Bahrain. Operating in this environment requires investors to discard their traditional volatility-chasing strategies. Success in Bahrain requires mastering a localized playbook, one built on strict rules and unique currency mechanics. Rule 1 of the Bahrain playbook: secure your capital structurally before you ever execute a trade. In this market, the Central Bank of Bahrain acts as a strict regulatory guardian. They serve as a vigilant supervisor rather than a passive office. Their non-negotiable mandate is segregated client accounts. Your capital is cleanly split and kept isolated from a broker's operational money. This segregation protects you. During broker insolvency, your funds remain locked and cannot be seized to pay their corporate debts. Verify this protection yourself before depositing any funds, simply by checking the CBB's public licensing directory. Verified CBB oversight rechannels your mental energy away from broker anxiety and entirely onto market strategy. That brings us to Rule 2, the peg. The Bahraini dinar maintains a fixed exchange rate of exactly $1 to 0.376 dinar. Tracking the BHD against the USD, the CBB uses massive foreign reserves to actively buy and sell currency, locking this exchange rate and removing volatility. Traditional trend-following strategies fail against this flatlined pair, only losing money to spread fees without capturing price movement. We move to Rule 3, the carry trade. This is your specific mathematical solution to generating profit when price action is entirely flat. To execute a carry trade, borrow a low-interest rate currency, like the Japanese yen, to buy a higher interest rate currency, like the dinar. You profit by capturing the daily interest rate differential between them, known as the swap, ignoring the lack of chart movement. The BHD's fixed peg perfectly protects the strategy because it eliminates the risk of a sudden exchange rate crash wiping out your accrued interest gains. Through the mechanics of the peg, the lack of volatility transforms from a day trader's worst nightmare into a predictable, mechanical engine for compounding interest. However, while the dinar is stable, trading global pairs like URUSD from a Bahraini account still fully exposes you to global macroeconomic volatility. Operating in the Gulf Cooperation Council requires monitoring a new set of localized economic drivers that influence broader market sentiment. Brent and WTI crude oil prices are the primary external indicators here. They dictate the economic health and risk appetite of the Middle Eastern region. Navigating that localized exposure comes with the ultimate structural advantage. The kingdom levies zero personal income tax and zero capital gains tax on individual traders. In standard jurisdictions, a heavy tax burden cuts deeply into your yield. In Bahrain, 100% of the profits generated from your carry trades or CFDs stay securely in your pocket. Stop fighting unpredictable volatility. Start trading strategically by opening a strictly regulated, tax-efficient account with FXNX. A genuine trading edge comes from choosing to operate within a structurally secure, heavily regulated, and tax-free ecosystem.